Emotional investing almost never feels like emotion. It feels like being careful. That decision from last year you still can't explain wasn't weakness. It was an ordinary mind in a place it was never built for. Over the next 20 minutes or so, 9 signs, 9 observable behaviors you can catch yourself doing, each with the pattern underneath it and one small correction. The 8th one argues back. Sometimes the plan really should change, and history has receipts. This isn't a warning, and it isn't a lecture on behavioral finance. It's a mirror, held at a comfortable distance. Nothing here carries a verdict on your character. You check these calmly, factually, and then you get on with your day. And nothing here is advice about your money. I don't know your circumstances, and I'm not recommending anything. This is a description of a mind, not a plan. One more thing before we start. I have done all 9 of these, some of them this year. Sign 1, the morning check. It's 10 past 7. The kettle is warming behind you, phone in one hand. You're not trading. You're not worried exactly. You're just looking, the way you'd glance at a clock. 9 seconds, and the day begins. Most days you do nothing at all with what you see. The sign here is the frequency, and the looking has a cost. Consider what a daily lens shows you. Since 1928, the S&P 500 has closed higher on only about 53% of individual trading days, close to a coin flip. Over calendar years, the same index has finished positive roughly 73% of the time. Same market, same history. Looking every morning teaches you nothing new. It simply selects the noisiest available resolution. And noise has a price, because losses land about twice as heavily on us as gains of the same size. Sample more often, and you collect more of the painful side of the same underlying return. In 1997, Taylor, Tversky, Kahneman, and Schwartz published an experiment in the Quarterly Journal of Economics testing exactly this. Participants split money between a risky asset and a safe one, with feedback arriving at different frequencies. The group shown the most information took the least risk and finished with the least money. They were as capable as everyone else in the room. They were simply more exposed. Bernarzi and Thaler had already found 2 years earlier in the same journal that the historical equity premium looks about right if you assume investors check in roughly once a year. A gardener who lifts the seedling each morning to inspect the roots is running an experiment on the plant's ability to survive being lifted. So the correction is small. Change the frequency of looking and leave the contents of the portfolio alone. Pick a cadence. Quarterly is plenty for most people, and let the number be unknown in between. If the thought of not knowing for 3 months brings a flicker of anxiety, notice that flicker. That's the diagnostic result. It's telling you the real issue is the size of the position, not the checking. Which brings us to what happens on the mornings you look and something has done rather well. Sign 2, the chart that already happened. Notice when the curiosity arrives. It shows up after the performance does, not before. You find yourself reading about something precisely because it has gone up, and the rise feels like evidence about what comes next, rather than a description of what already came. The cost of this has been measured. Morningstar publishes a study each year called Mind the Gap. It compares what funds returned with what the average dollar invested in them actually earned. Over the 10 years ending December 2024, the funds returned roughly 8% a year. Their investors earned roughly 7%, a shortfall of about 1.2 percentage points annually, which Morningstar estimates consumed around 15% of the fund's total gains. Let me turn that into a figure you can hold. Take $100,000 over those 10 years. At the fund's return, you'd finish with roughly $220,000. At the investors, roughly $197,000.
About $23,000. No fees, no crash, no bad fund. The whole difference is when the money arrived and when it left. That's an illustration of the past rather than a forecast, and the exact size of the gap is argued over by researchers. The direction of it holds. Nobody in that data made a dramatic mistake. In aggregate, they added after good stretches and withdrew after bad ones. The vivid version of the same instinct. The NASDAQ composite closed at a little over 5,000 on the 10th of March 2000, fell to around 1,100 by October 2002, a decline of about 78%, and didn't close above that March 2000 level again until April 2015, 15 years. Money flowed into technology funds most heavily near the top. Enthusiasm was highest, exactly where the arithmetic was worst. The correction: move the decision off the chart and onto the calendar. If contributions happen automatically on a set date into a set allocation, recent performance loses its vote. And when you catch yourself researching something, try finishing the sentence out loud. I'm interested in this because it already went up. Said plainly, it usually resolves itself. Now, the opposite corner of the same portfolio, the one you've stopped opening. Sign 3, the position you stopped looking at. You know your winner's numbers by heart.
And there's one you haven't looked at properly in months. You'll deal with it when it comes back to what you paid. That sentence is the sign. The purchase price has quietly become a finish line, and selling below it would turn a private disappointment into a permanent, admitted fact. Terence O'Dean documented this in the Journal of Finance in 1998 in a paper called "Are Investors Reluctant to Realize Their Losses?" He examined the records of roughly 10,000 accounts at a large discount brokerage. Investors cashed in about 15 of every 100 winners they held, and only 10 of every 100 losers. Then the second finding: the winners they sold went on to beat the losers they kept by about 3.4 percentage points over the following year. The behavior inverted the outcome. And in some tax systems, realizing a loss is one of the few moments the rules work in your favor. Worth checking how that applies where you are. Here's a quiet way to feel it. Imagine you inherited your exact portfolio this morning. The same holdings, today's values, no purchase prices attached anywhere. Which would you keep? Most people find at least one position survives only because of a number that exists nowhere in the world except their own memory. So retire the purchase price as a decision input.
The only honest question is whether, knowing what you know now, you'd buy this today, at this price, in this size. Your cost basis is a fact about your past. The asset has no idea what you paid. Which raises a question we've circled twice already. That word, size. Sign 4, the size that wakes you. This one is physical before it's financial. A single holding is large enough that a headline about it changes your mood, or your sleep. You can be entirely right about an investment and still be wrong about the size. Conviction is a feeling, and it's a poor input into position sizing, precisely because it feels so much like knowledge. 2 anchors. Hendra de Bessenbender, writing in the Journal of Financial Economics in 2018, examined the lifetime returns of roughly 26,000 U.S. common stocks going back to 1926. About 58% of them failed to beat one-month Treasury bills over their entire lives. The whole net wealth creation of the U.S. market across that period, on the order of $35 trillion, traces to the best-performing 4% of companies. The other 96%, collectively, roughly match Treasury bills. Read that as a statement about concentration. The market's return lives in a handful of names, which makes a portfolio of a few names a very different animal from the index it superficially resembles. The human anchor, and I want to handle it gently. At the end of 2000, Enron employees held about $2.1 billion in the company's retirement plan, roughly 62% of it in Enron stock. The company filed for bankruptcy on the 2nd of December 2001. These were loyal people holding the business they understood best, and the concentration was invisible to them because it felt like knowledge rather than risk. The lesson sits in how the plan was built, not in the character of the people holding it. So treat sleep as a legitimate risk metric, possibly the most honest one you own, because it responds to your actual exposure rather than your stated tolerance. Size every position so that being completely wrong about it is survivable and boring. A holding you can be wrong about without flinching is a holding you can actually keep. The next one hides in something that looks like homework. Sign 5, an opinion for every headline. Somewhere along the way, having no opinion started to feel like negligence. On the rate decision, the jobs number, the election, the new technology. More information reliably produces more confidence. Past a very low threshold, it stops producing more accuracy, and that surplus confidence has to go somewhere. Usually, it goes into the portfolio. The psychologist Paul Andreasen ran experiments with business students at MIT in the late 1980s using a simulated market.
One group received a steady stream of news about their holdings. The other saw only prices. The group with no news traded less and finished with better results. The field data agrees. Brad Barber and Terence O'Dean's paper in the Journal of Finance in 2000, called "Trading is Hazardous to Your Wealth," tracked 66,465 households at a discount broker from 1991 to 1996. The average household earned 16.4% a year against a market return of 17.9%, turning over about 75% of his portfolio annually. The most active traders in the sample earned 11.4%, 6.5 percentage points behind the very market they were working so hard to interpret. Those households worked harder at this than anyone in the sample. The work is what it cost them. A sommelier who tastes 40 wines in an afternoon doesn't finish with 40 times the discrimination. Past a point, the palate stops reporting anything useful, and the confidence keeps rising anyway. The correction here is a line, and I mean a written one, interesting on one side, actionable on the other. For most long-term investors, the honest list of things that should change the plan has about 3 items on it, and none of them are in this week's news. You're allowed to find the news fascinating and still owe it nothing. Let's pause here, because something has turned. The first 5 signs might sound like a case for feeling less.
There's something narrower than that. You will not become a person who doesn't flinch, and the people who claim they've managed it are usually the least aware of what's moving them. What changes is the distance between the feeling and the hand. Every correction so far has been a way of adding a few inches there. 4 to go, and the remaining ones live further downstream, where feeling has already become a sentence you say out loud, and the sentence has become a decision. Starting with the most reasonable-sounding sentence in all of investing. Sign 6, waiting for the fog to lift. I'll go back in once things settle down. Moving to cash to wait for clarity has the whole texture of prudence, but it contains a hidden second decision, the re-entry, and that one almost never gets made deliberately. The arithmetic is awkward. J.P. Morgan Asset Management's 2025 Guide to Retirement follows $10,000 invested in the S&P 500 on the 3rd of January 2005 and held to the end of 2024. Fully invested, it became $71,750, about 10.4% a year. Missing only the 10 best trading days across those 20 years left about $33,000, roughly 6.1% a year. Some $39,000 of difference on a $10,000 start, decided by 10 days out of 5,000.
And the detail that makes timing hard rather than merely difficult. Over that period, 7 of the 10 best days fell within 15 trading days of one of the 10 worst. The stretch that makes you want to step aside is the stretch you most need to be standing there for. History gives the same lesson in miniature. Between the 19th of February and the 23rd of March 2020, the S&P 500 fell 33.9% in 33 days, the fastest descent into a bear market on record. Clarity, in the ordinary sense of that word, did not exist in April of that year, or May, or June. Yet the index reached a record close that August, just under 3,390, which tells you something about the nature of clarity. It arrives on a delay. It settles over you some weeks after prices have already recovered, which is exactly what makes it useless as a re-entry signal. By the time it comes, the thing you were waiting to see safely has happened without you. If your risk level truly is too high, lower it permanently and in writing, as an allocation you'll keep in good weather too. Permanent changes have a reason. Temporary ones have a mood. And listen to how we've started describing all this, as if something out there were doing it to us. Sign 7, the market as a someone. Listen to your own grammar for a moment. The market punished. The market wants. The market is testing us.
Underneath the figure of speech sits a real belief that you're in a relationship with something that has intentions toward you. Once the market is an adversary, every move becomes personal, and personal is where discipline goes to die. On the 19th of October 1987, the Dow Jones Industrial Average fell 508 points, from about 2,247 to about 1,739, a drop of 22.6% in a single session, still the largest one-day percentage decline in its history. No war had begun, no president had died, no earnings report explained it. The Brady Commission's investigation afterwards pointed largely at mechanics, portfolio insurance, and program trading interacting in ways nobody had modeled. And yet, within days, the papers had produced a full slate of confident motives, because a market that falls for structural reasons is unbearable to write about, and a market with intentions is not. The part almost nobody remembers: the Dow finished that same calendar year up about 2.3%. The worst day in the index's history sits inside an unremarkable year. A storm is not aimed at your roof. It has no opinion about you. It didn't notice you were there, and the response it asks for is having built the roof properly beforehand. So listen for the pronoun.
The moment the market becomes a they in your own speech, you've started keeping score against something that isn't keeping score against you. It's an auction made of millions of people with different horizons and different needs, and it does not know you own it. But a storm you take personally tends to get answered, usually within 90 days. Sign 8, the quarter that rewrites the plan. Here, the sign is that your allocation has changed more often than your circumstances have. A plan built for 30 years gets revised after 90 disappointing days. Part of that is a poll we share with goalkeepers. Bar Ali and colleagues, in the Journal of Economic Psychology in 2007, analyzed 286 penalty kicks from top leagues and international play. Keepers dived left or right on about 94% of kicks, yet staying in the center stopped a third of them, against roughly 1 in 7 for a dive. They knew the odds. They dived anyway, because a goal conceded while standing still feels far worse than the same goal conceded while diving. Doing something is emotionally cheaper than doing nothing, even when nothing is correct. Now the objection, and it deserves more than a sentence, because never change anything is not automatically wisdom.
The Nikkei 225 peaked at just under 39,000 on the 29th of December 1989 and did not close above that level again until the 22nd of February 2024. 34 years. A patient Japanese investor who bought the index at the top and held with perfect discipline waited most of a working life to break even in price terms. That happened to real people who did what everyone told them to do. Nor is it only abroad. For U.S. large caps, the decade from the end of 1999 to the end of 2009 produced an annualized total return of about -1%, the only negative calendar decade since the 1930s. 10 years of contributions, discipline, and nothing to show. And individual giants have simply not come back. General Electric, the most valuable company in the world around the year 2000, was removed from the Dow in June 2018 after 111 years as its last original component, and had not regained that peak by the time it left the index. Citigroup ran a 1-for-10 reverse stock split in May 2011, a permanent piece of arithmetic marking how far it had fallen. So what actually protects a patient investor here? 3 things, specific rather than spiritual. First, diversification, which is why those are cautionary tales and not universal ones. Across that same lost decade for U.S.
large caps, the equal-weighted S&P 500 returned mid-single digits annually, and mid-caps, small caps, and emerging markets did substantially better than the cap-weighted headline. A globally diversified portfolio did not have a lost decade. Second, owning the broad market rather than a handful of names, so that no single General Electric decides your outcome. Third, the one people skip, sequence of returns planning. Someone who retired in 2000 and spent that decade drawing down faced a different problem from someone still accumulating through it. That problem is usually solved structurally rather than by timing. Some people hold a few years of spending somewhere that doesn't fall with stocks and keep withdrawals flexible, decided in advance while nothing is falling. So give yourself full permission to change the plan, but only for a reason that would still be a reason if the market were up 20%. A new child, a changed income, a nearer retirement date, a horizon you misstated at the beginning. Those are facts about your life. A bad quarter is a fact about prices. Write the difference down while you're calm and let the written version make the call when you're not. One left, and it's the one you'll hear yourself do at a dinner table. Sign 9, the story you own. Someone asks what you own. Listen to your answer.
If it comes out as a narrative, the company changing how we do this, the theme that's obviously the future, and no number appears anywhere in it, then what you're holding is a story. And stories can be rewritten overnight in a way that ownership stakes cannot. There's a study that measures this directly. Cooper, Dimitrov, and Rao published Arose.com by any other name in the Journal of Finance in 2001. They found 95 firms that added .com to their corporate names during 1998 and 1999 and measured the market's response. Cumulative abnormal returns of about 74% over the 10 days around the announcement. The finding that matters is what came next. The effect was similar regardless of the firm's actual involvement with the internet. A company that changed nothing but its letterhead was rewarded nearly as well as one rebuilding itself from the inside. Investors were pricing a suffix. The calm version of that test, at home, describe your largest holding to someone in 2 sentences without using a single adjective. If you can only say what it means and can't say what it is or what it costs relative to what it earns, that's useful information about you and not about the holding. So aim to say why you own each thing in one plain sentence with a number in it, a valuation, a fee, a role in the plan, a percentage of the whole. For a lot of people, the honest sentence turns out beautifully dull. I own a slice of thousands of companies, cheaply, because I need this money in 20 years. Dull sentences survive bad news. Stories don't. That's 9. You've probably recognized yourself in 2 or 3, and almost everyone does. Every one of them is what a mind built to notice danger, act quickly, and prefer stories to spreadsheets looks like when you pointed at a stock market. That mind kept your ancestors alive. It's simply not calibrated for an instrument that rises over decades and falls over days. So go back to where we started. That decision from last year you couldn't quite explain. You can probably name its number now. Maybe it was 3, and there's a position you still haven't opened. Maybe it was 6, and some money is still waiting for a fog to lift that lifted a while ago. Whichever it was one of 9 ordinary behaviors, and now it has a name, a pattern, and a correction the size of a sentence. Because that's all any of these ask for: a quarterly cadence instead of a daily one, a written line between interesting and actionable, a position size you can be wrong about and still sleep, a rule that lets the plan change for facts about your life and never for facts about last quarter's prices.
Small distances, every one of them, but each is a place where the version of you that woke up worried hands the decision to the version of you that thought it through. And you already have that second one. It's the one listening now. If any of the 9 landed somewhere specific, I'd genuinely like to know which. Leave a comment with a number. And if this way of thinking is useful to you, subscribing means the next one finds you. No hurry. Take the quiet with you.